Okay, welcome to Random Rogers Big Picture for the week of October 1st. I'm going to try and do two things with this video. First, talk a little bit about the quarter, and second, try to answer a question about sector rotation that came in a comment on the blog. First, about the quarter. I should probably preface this by saying we, as a company, we're trying to sort out how we can disseminate information compliance-wise and so forth. And it appears as though, or at least for now, we think we can't really write about performance, but it looks like it's okay to talk about it. I know that sounds ludicrous, but to give you an idea of how crazy this is, comments on the blog can be thought of as testimonials. How you doing? So we'll try and just talk about the quarter a little bit. If you've been reading the blog, you know that I have lagged the market this quarter. The lag was just a hair under 3%, and I did a little looking at the portfolio and a little bit of counting, and actually about 2/3 or maybe even a little more of the lag came from just three stocks: Yahoo, Statoil, and the double short ETF. So the portfolio didn't really unravel. It's just one of those things where a couple of things happened pretty much at the same time. So it's tough for me to, relative to my normal lack of emotion, it's pretty tough for me to get too worked up about the lag, especially from the standpoint of, and I've been saying this from day one of the blog practically, there are going to be years and there are going to be quarters where you lag the market. It's not possible to always beat the market, and it's not possible to get every call right or every shift or however you want to describe it. So, yeah, I wish I beat the market this quarter, but I didn't. So that's that. Let's move on to the question about sector rotation. Reader kind of wanted to get a feel for specifically how that works or how that looks or whatever. And the short answer is I start with what the S&P 500 looks at, or weighs each sector at, I should say. And then I go from there based on where I think we are in the economic cycle and where I think we are in the stock market cycle. I'll go ahead and overweight or underweight based on a couple of things, sort of a knowing of how things usually work historically combined with what I think is going on right now, and hopefully that leads me to a successful forward-looking analysis. To give you some examples, industrials. I reduced the sector a little bit in the spring. I sold Caterpillar in half after it had a big run. It had a fabulous first part of the year. It was up 35% maybe. You can check a chart if you want to double check whether I'm right or not. But either way, it's one too many double checks, baby. Anyway, thinking that the economy might slow down, I sold down the position. Industrials, you would expect, might not do as well, might not provide leadership if the economy is slowing down. That's one example. About a month or two later, I added to a consumer name. Most people have Walgreens. I added a little bit of exposure. I think it was in June, around $42, and for a while, that was looking pretty smart. Then, in the last couple of weeks, the stock's had some bad news, and I'm still up on where I added the position, but nonetheless, it hasn't worked as well in the last few weeks. But that kind of gives you an idea. You would expect that defensive type consumer, gotta have it type products would do well if the cycle is ending, and I kind of think that it is. So that's one example. Throw out some other ideas. Media tend to be thought of as a late stage type of sector. Semiconductors are thought to be early stage. Copper, and you could probably throw in nickel, are also thought of to be as early cycle type plays. So just kind of knowing how markets tend to work, or how sectors tend to work with regard to the cycle, is a big part of it. Another example where I started out being right and then I gradually shifted to being wrong would be in technology. I've been underweight a little bit for a long, long time. Then I started reducing exposure probably fourth quarter last year, maybe first quarter this year. I reduced it down to being very light, and as it turned out, too light. I was maybe in the neighborhood of half of the sector, maybe a shade under, and that turned out to be too light based on what we saw this quarter. The technology did very well, and it didn't really hurt so much as it would have helped if I had had a little more exposure to the sector, if that last comment makes sense to you, and think about it where, it was Yahoo and the other names that hurt the portfolio. But that's kind of an important part, is knowing history. Well, I get asked, like in interviews, this was the case the other day in an interview, and occasionally I'll be asked, Well, what should a new investor do? And I think what a new investor needs to do is get a Trader's Almanac and do some other things to learn market history. There are certain times in the cycle where various sectors just have the wind at their back. That's just how it works, or other times where the wind is in their face. And knowing this and kind of puts the odds in your favor a little bit. That might make the job of portfolio management, managing your own portfolio, a little easier, which is kind of the whole point of why I have this website. If that is not clear to you, then go ahead and send in an email or leave another question, and we'll see if I can follow up, but that's kind of the basics of it. Thank you.